Hey guys, Toby Mathis here, and I'm going to talk today a little bit about the actual costs of mutual funds. Very, very difficult to ascertain, and there are different estimates depending on where you look. I tend to point to the Forbes article that had it between 4.8 and 5.8. It's about 10 years old, but it still holds true today. There's plenty of other sites where if you just type in things like the real cost of mutual funds, you can actually see lots of commentary on it. And the problem is this, is that the expense ratio that's reported, that's required to be reported on the SEC, it's generally just talking about the cost of overseeing this mutual fund, which is really just a company set up by, let's say a financial house. It's being operated and there's costs for operating this fund, which goes out and buys most of the time you're just talking about buying stocks and bonds and things like that. It's investing the money. The problem that we have right out and inherent in any mutual fund is there's two things that they don't get to account for right away. Number one is the cash drag, meaning that they have to stay liquid to a certain extent so that they can pay out people that want to exit versus the money that's coming in and getting deployed. That's a little bit of a problem. And the estimates, depending on where you look on a cash drag, is somewhere about 0.8 to 1% a year just by not having your actual funds deployed into investments compared to an ETF, which doesn't have any cash drag. That immediately puts about a 1% a year benefit on the ETF. Number two is you can't tell what the heck is in them. They're not disclosing what they're investing in. It's almost impossible to find out on any given day what the holdings are unless you know somebody that's working at the at the company and you have some sort of inside track. But as a member of the public, I'm not going to be able to tell what's inside of a mutual fund. And they may be investing in other companies that you've already invested in, or you may have mutual fund A and mutual fund B, and they both have a 30% stake in the same company, and you think you're diversified, and you're not. But when they go in and they buy, here's something to consider. When a mutual fund goes in and they're going to allocate all of their resources to go buy, let's say that you have A and B buying company ABC, and they're both allocating a bunch of money and they're buying these for their funds. What do you think that's going to do to the price of the company you're buying? It's going to drive it up. So you typically have a bid and an ask. And if all of a sudden I have a whole bunch of order and I'm going into a position, so I'm buying $1 billion worth of stock, what do you think that's going to do to the price of the stock? Yes, these companies are going to try to space it out, and there's always going to be this argument, oh, I'm spacing it out and other things, but that's still an added cost. It's going to push it up. The other thing that we've seen is since the mutual funds first came out, they had what they call a turnover ratio, which they would turnover ratio about 17%. So they're turning over the stocks, about 17% of the companies. Right now it's sitting over 100. And that's not a free transaction. They're charging you to do these transactions. And when you sell something, you should immediately go ding, ding, ding. That short term, that means there's a taxable event and there's a taxable cost to me because of that, which also, depending on where your estimates are about 1%. In other words, I could buy into a mutual fund that, again, let's say it's company ABC, that's appreciated, and I know they're going to turn it over within a year. If I buy in and the day after they sell it, guess who's getting hit with that tax? This guy right here, me, right? Because on the day that I'm owning it is when the taxable event occurs. That's how it works. Don't shoot the messenger, right? And so I'm getting hit with these things. The other costs are something called soft dollar costs, which means here's big investment house and they're buying lots of research and data and other things that are part of their normal operations. How do they allocate it? Do they allocate it to the mutual fund? Do they allocate it over here to their high net worth clients? Are they basically saying, hey, we're going to let these mutual funds over here bear the cost of all these costs? Like, how are they allocating it? Because we don't know. And if you say you know, you don't. Like, there's nobody that here that sits there and discloses, well, you are, 13% of our total revenue invested, and we're going to take our costs and we're going to allocate 13% over. That's not how it works. It's not transparent. And so there's all these soft dollar costs. We don't know whether they're putting it all to fund A, the one you invested in, and there's no costs over to fund B, which means they're not an intended beneficiary. And a lot of that's supposed to be buried into the overall expense ratio anyway, the cost of managing, but they're not. And then you also have things like management fees. Like quite often what you find is that not only is there a management fee for the mutual fund, but you're being charged a fee for someone to buy the mutual fund for you, to select it. And you add all those things up, and it's about 4.8%. I'm looking at another one. Common Sense Financial had it at 4.17. Forbes had it at 4.8 to 5.8. Me personally, having seen these broken down, we're between 4 and 5%. So I have plenty of portfolios where you run it through the analyzer to see what the actual expenses are that are on an account. You do it after the fact. You're doing 2020, saying here's what they actually charge, because you can tell once the tax year's over, you can see here's what I invested, here's what I made, here's what the actual represented gain was. Let's say you had 100,000 and they said we made 7%. Well, you should have 107,000. If it's 103,500 that's sitting in your account, then you paid 3.5% for the expenses, right? So you can actually kind of reverse in and figure out what these are. And there's also companies that track it by breaking it down and actually figuring these things out on statements. And then they apply it to anybody else that's also in that mutual fund. So there are places like I work with a fiduciary who has software where that's what they do. And it's usually around 4%. I'm just going to say that, compared to an ETF, where the ETF management's usually around 90 basis points, so about 0.9%, 1% ish, and there's no cost. Like I could go buy an ETF tomorrow and I could see exactly what's in my ETF. And so you're seeing ETFs just take off in popularity because I can get the same diversity. I could have an ETF managed also. A managed ETF would probably be about 75 basis points to 100 basis points, which means I'm all in for far less than what it would cost on average for a mutual fund. And I can buy it anytime, I can sell it anytime, and I'm not sitting here dinking around with all these hidden costs of the mutual funds. And that's why I tend to say that, be careful with mutual funds. Not a huge fan. They're not all bad, but it's really, really tough to tell which ones are the good ones. Like it's really tough. You have to usually go to somebody who is a fiduciary, who's looking out for your best interest, who has access to the tools to be able to decipher and get down to what the actual costs are. And there's still a lack of transparency that's never going to be there compared to an ETF, which any day I can see exactly what's in there. I'll never have that with a mutual fund, at least not the way that they're set up today.